please take your seats and welcome to the stage the future of C-Suite.
Hello. Hey, everyone. Thanks for joining us for the Future C-Suite panel. Before we get going, I'll have each of the panelists introduce themselves, and then we can get into the hard-hitting questions. Go for it. Aviva?
Hi, everyone. I'm Aviva Hotimsky. I'm a principal on the real estate equity team at KKR. And at KKR, I spend the vast majority of my time on our hospitality platform, where, along with Akshay and team, we have about $1.2 billion portfolio of hotels and active acquisitions and asset management pipeline.
Yeah, when I was talking to her.
My name is Jonathan Patel. Hey, how's it going? I'm Jonathan Patel, Senior Vice President at Hunter Hotel Advisors. I've been with the company for over 8 years. I work directly with Teague Hunter and Lee Hunter on just about every deal. Over the last couple years, we've done over $3.5 billion in transactions across all service lines.
Hi, everybody. Katie Minnick, Senior Director of Investments at Noble Investment Group, which is a private equity firm based here in Atlanta. I'm responsible for executing on our acquisition and development strategies across our investment funds.
Hey, everyone. Hello? Is it working? Hello? Much better. Hey, everyone. My name is Aman Gupta. I'm a Vice President of Acquisitions at Starwood Capital Group. I've been there for about 9 years and focused on hotels in the leisure space.
Great. So, you guys have been selected as the future C-Suite panels, and at a very young age, you've all built incredibly impressive resumes at great organizations. So, for the crowd, maybe first we can get into, what is special about the culture of each of your organizations that have really, enabled and empowered you guys to reach the positions you're in?
I'll take,
Yeah.
Since I'm sitting next to you, I'll take first on this. I think something that is unique about KKR, something that I think we do very well, is from a very young age, be it analyst or associate, you are expected to be part of the deal team, have a view on the deal, and really be part of the debate and discussion over kind of everything we're doing, be it your specific deal, but also the broader platform. And so for me coming in, I'm somebody who has always liked asking a lot of questions, digging in, and really being part of the full transaction. And I think being in a culture that's enabled that and that's really helped me grow in that has certainly been kind of a large contributor to my success at KKR.
Yeah, for us, company culture is family, right? So Bob Hunter started the company 45 years ago. The conference has been going on for 35 years, and now Teague and Lee run and lead every single day. And when I got hired, my very first day, Teague said, my name is now Jonathan Hunter Patel. And so I thought that was really funny and cool. But outside of the family dynamic, which I'm sure many of you know, it's very unique for us to have an open door policy. So we have some really good people at our shop that have been there for a really long time. Mayunk's been there for over 15 years. David Perrin's been there for over 10, same as Tim Osborne. And so having the ability to be on calls with them and learn about companies and all the service offerings that this industry has and how they're all interconnected is absolutely incredible. And it's great for our young talent to come in and kind of get thrown into the fire immediately on being every single deal. So it's really cool, and brokerage is really unique in that perspective.
I agree. I mean, I think similar themes at Noble. Noble attracts incredibly driven individuals, and so it provides a platform for those individuals to really take the ball and run with it. And kind of similar to what both panelists were saying is that there is kind of an open door policy, and so there's a lot of collaboration across the different disciplines, which allows you to continue to grow professionally and really start to learn from your peer set, which is something I've really enjoyed during my time at Noble.
It's funny. It feels like companies with good cultures all kind of look the same, but companies with bad cultures look very different. So I'd agree with a lot of what you guys have said. And I think one thing, if you are an ambitious person and a restless person, having the ability to grow is critical. And Starwood's pretty good about that. And I think it boils down to three major reasons. One is the funds themselves are growing, so the firm is growing. Two is the firm is staffed pretty leanly, so there's a lot of slack, so you naturally have things that you can pick up. And the last thing is good mentorship that helps you navigate this growth, because without that, it's really hard to add responsibilities and grow.
So talking about mentorship and management, and maybe you can start with this. Can you tell us a little bit about your experience while you were being managed or menteed versus now that you're managing people? How's that changed your view on management?
Just so everyone knows, Akshay used to be my manager, so this is there's a personal element to this question. I think the biggest surprise for me going from being managed to now managing is how much pressure your manager is under, which I don't think I appreciated at all. For some reason, and this is looking back, this is silly, I thought the game that you're playing gets easier as you get higher up in an organization. But obviously that's not true. The amount of variables you have to keep track of is increasing. It's getting actually exponentially harder. So I think what was shocking to me was, despite the amount of pressure that Akshay, when he was managing me, was under, he was still able to have the time to mentor me and put in the effort to mentor me. So the standard for the amount of effort you need to put into mentorship is pretty high, and he set that standard for me.
That's very sweet of you, but you're very easy to manage. Continuing in this mentorship theme, best piece of advice you've ever received? Jatin, maybe you can start.
Yeah, I think the best piece of advice I've received is to have empathy, to put yourself in the other person's shoes. I grew up in this industry. My family's been in this industry my entire life, and so I essentially grew up in a hotel. So I kind of understand the dynamics of hotels from top to bottom, bottom to top, all the way from front desk and housekeeping, all the way to underwriting and acquisitions and asset management, and having that empathy and understanding every single individual and how they're all connected has been really meaningful for me to be successful in my career.
Katie?
Probably just that relationships really matter, and investing in them appropriately will go a long way. I think it goes up and down the spectrum too. Junior people in the industry, outside of the industry, I think there's a lot that you can learn from everybody around you, and I think that that's something to just really keep in mind as you're interacting kind of day to day.
Somewhat in line with Katie, but a little bit different. I think, you spend a lot of time with people you work with. And so, Akshay and Aman might laugh at this because we were talking about this last night, but, surrounding yourself with people who are smarter than you, who you really enjoy and really respect, and, because you spend most of your day with them, I think is very important. And I've been fortunate to find some place where I continue to learn every day, and I think that that's really special.
Yeah, certainly special and rare. So it's something to be treasured. The best advice I ever got was that self-awareness can be a superpower, but as long as you don't take it too personally. So be aware of your weaknesses, be aware of your strengths, but don't be harsh on yourself. View it dispassionately. So kind of have a Zen-like quality to it.
It's great. Some amazing advice. So let's get into just your roles and the actual job. Jatin, you're at Hunter, the largest broker in the select service world. Interest rates have risen drastically in the last 2 years. We have learning to live in a environment with 7, 8, 9% rates instead of 3 and 4, and that's really stalled large transaction volume. But sort of this $10-20 million trade seems to be readily available and very active. Why do you think that part of the market has really behaved so differently?
I think what we've learned is a lot of our one-off transactions are typically motivation driven, right? And so, you have potentially a buyer that comes in, regional, local owner operator can come in and buy an asset that's local and proximate to their existing portfolio. It could be where they have some type of motivation via 1031. It could be where they're sitting on dry capital and they're doing really well with their existing portfolio and they're just looking to deploy capital in their local area. So I think for the one-off deals, we've seen a lot of success with the local owner operators. And I think, like you said earlier, deal size has a lot to do with that too. So for us, sub 20, sub 25, we do really well. And so, we're representing, I think, all of you right now in a listing or an active listing or a deal that's under contract. And I think we're having a lot of success finding that individual in that kind of corner of every market. And I think that's driven success for us.
Great. And Aviva, you've been a big seller over the last 2 years. What has been the decision process as you've been thinking about the sale process and why you decide to sell? Are you buying as well as selling? Are you a net seller? How are you thinking about all of that?
Yeah, I think it's a great question. Maybe looking back to 2022 when we originally started selling hotels, in 2021 and early 2022, we bought about $1.5 billion worth of select service product. And some of that was a large distressed portfolio, and some of it was more one-off, single asset and small portfolio transactions. And during that time, fundamentals recovered, some of the business plans we were able to pull forward, and we found ourselves sitting at the end of 22 with assets that had kind of fully matured, achieved their business plans, and then within that large portfolio, a number of assets that were just not as well suited for institutional ownership and were a little bit less core to us. And so throughout 2023, similar to what Jen said, there was real liquidity for, $10, $20 million transactions. And we sold about $300 million of assets, about 20 different assets in single asset to call it 5-pack transactions. And what that enabled us to do was put some wins on the board for, a relatively new strategy and, prove out the business plan. B, allowed us to prune our portfolio to kind of a pro forma portfolio that we were very excited to own. And then C, there's real tail risk in the world. And while that didn't necessarily materialize, I think taking some chips off the table was kind of the prudent decision for us at the time. And so, where do we sit today? I think, we are continuing to sell more, and we have a number of assets in the market for kind of similar reasons, except maybe less of the third prong. But we're also active on the acquisition side and looking to invest. And I think that's kind of the cycle of, what all of us see up here is there's times to sell, there's times to buy, and there's times when you're a buyer and a seller. And I think today is the latter for us.
And Katie, for you, this high interest rate environment where transaction activity on the acquisition front has stalled, has brought a new wave, it seems, of development, especially on the mid-scale extended stay side. Can you tell us a little bit about how Noble and you're thinking about that side of the world and why you're heading into the development route?
Sure, and I think on top of doing development right now, we are still an active buyer and we are actively selling a few assets. But from the development lens, Noble's always been a big developer. We'll still do great hotels in markets like Savannah or San Diego, but as it relates to kind of this mid-scale extended stay segment, there are certain fundamentals about it that are very interesting to us. And so when you're looking at a challenging interest rate environment, but you're looking at this kind of mid-scale extended stay product where you can build to a double-digit unlevered yield after first year of operations, that's pretty interesting to us. And so it's generating cash flow, which, during a time that it's challenging to generate cash flow. And so for us, that makes the development piece a little bit more interesting. But Amin, what are your thoughts? Hyatt, Marriott, Hilton entering this space. You guys are one of the bigger extended stay owners with ESA in town. What are your thoughts on those brands?
Before I go into that, you talked about current cash yield. What's interesting is, cap rates don't move in lockstep with interest rates. Generally, over time, as interest rates rise, real estate owners will just accept a lowered unlevered yield, and part of that is they expect higher growth, and part of that is if you want to get a deal done, you just have to accept lower current cash-on-cash yields. So it's just an interesting thing that it might be something that we need to get used to as an industry as well. That's part of what might cause acquisitions to start happening again. Like the days of 17% cash-on-cash in a hotel deal are over. It's now 10 to 11%. More of it is back-weighted. Those are just the kinds of risks that you have to take now. But going back to extended stay, over the long term, the extended stay space has seen 4 to 5% CAGR in new supply. You compare that to the overall hotel industry, the long-term average is closer to 2%. And while that's happening, you've still seen occupancy growth in the extended stay space, so demand is outpacing supply. And if you look forward over the next couple of years, you see the same amount of supply in the pipeline. You see 4 to 5%. And if you break down that new supply and look at what percentage of that supply are these new entrants, the new brands that have been announced, it's just about 1%. So are we thinking about these new brands? Absolutely. Are they going to have an impact on our business? Absolutely. We don't see that impact happening in the near term. And the one other thing that gets us comfortable is the mid-scale extended stay space is quite a bit above where extended stay suites and extended stay select prices. So ultimately, we think the impact will be fairly limited.
Great. That makes a lot of sense. You mentioned we'll all have to think about getting used to a world where, instead of the 15 to 20 cash on cash, we're more making high single digits, 10% cash on cash. How has that changed Starwood's mindset in the kinds of opportunities you guys are looking at compared to what you were looking at, say, in 2017, 2018?
Totally, because your exit, because your reversionary value, your liquidation value matters so much more for your returns. We're moving up the quality spectrum now. So, you want to buy assets where if rates go down and you get lucky, you can see yourself selling it for a 5 cap, for a 6 cap. So we're spending a lot more time in the luxury segment now than we did over the last couple of years. I'd be curious to see how you're seeing buyers' appetites change, Jatin.
Yeah, I think buyer appetite is normalizing and stabilizing, like you guys said. Cash on cash returns 15 to 20%, sometimes north of that. Was a norm when I joined Hunter 8 years ago, 9 years ago. We don't really see that today, even in the economy extended stay space. As we're dispositioning assets for Blackstone and Starwood, we don't really see that. We're seeing different metrics being quoted now. If it's per key replacement cost. And things like that is a big determining factor for dispositions on Starwood and Blackstone's end, but also from the buyer's side, they see potential exit value. They're seeing replacement costs being 130 a key plus at times for mid-scale and economy extended stay, and if they can pick up an asset south of or around 75, 80,000 a key in their local market, I think it still works for them. And for the regional buyer, they don't technically look at it on a 5-year hold all the time. They can kind of look past that and realize that, hey, maybe I'll only find value in year 6, 7, or 8, and they're ready to hold. And so we're seeing that now.
And what do you think, Aviva, will change in the world that'll really trigger further transaction activity in the world to really open up such that we'll start seeing much more volume, higher quality stuff back on the market?
Yeah, I think it's easy to obviously say lower rates and normalize inflation, but put that aside, I think something that's been interesting that we've seen this year, and I'm curious your thoughts on this as well, is we've seen a real functioning CMBS market and real volume in hospitality, but importantly in other asset classes in industrial and multifamily that really didn't exist last year. And so, as we think about, the various kind of size of, acquisitions, we've been talking a lot about the $10 to $20 million acquisition. John can speak a lot better to it than I can, but that's, very much a regional bank borrower that's remained active. I think where you've seen the other three of us on the couch, sitting on the sidelines, is those large-scale acquisitions where we couldn't get financing. And I think as debt capital markets continue to stabilize, as the CMBS market particularly continues to stabilize, that should help facilitate additional transaction volume.
Yeah, absolutely. As levered buyers, the availability of debt and the pricing of debt is incredibly important. I'm curious because I think KKR and Starwood has a similar LP makeup, but I think Starwood and Noble does not. Part of our job is to provide levered long real estate exposure to these LPs, and so not putting out money for a year or 2 years is something we discuss a lot. Like, regardless of how we see fundamentals, our job is to give them that exposure. So if we're not doing that, then their portfolios go out of whack. I'm curious what you guys think about it at Noble and how you guys think about it at KKR.
It's definitely something that we talk about. Fortunately, Noble has been very active over the past couple of years. Since 21, we've done about $2 billion of acquisitions, and so we are putting money out, to your point. But it's a challenging environment. Debt is expensive. There's still the bid-ask spread between sellers and buyers, which makes things challenging. But I think the green shoots of it is that hotel real estate is still a segment of real estate that you can still get positive leverage, depending on the deal that you're looking at. And so I think that still creates interest and volume in the space relative to some of the other real estate classes that particularly our investors are exposed to, that just have different struggles right now in terms of how they're performing, where their yields are, and some of them are totally upside down. So,
yeah. And I think on the other side of that, one, it certainly is a question we grapple with a lot and debate a lot. When we look at, we're on the other side of Noble, where we invest across every asset class and historically haven't invested in hotels as much. And I think the big question that we always grapple with is just what's the relative risk reward across asset classes and where do we want to deploy capital? When we look to, where we were investing last year, we didn't invest in hotels last year. And instead what we were buying was a lot of really core industrial, multifamily, student housing that, because there was no core buyer out there, we were able to price to value-add opportunistic returns. What's been interesting with the start of this year is that pricing has started to tighten again. And when you think about relative risk reward, on the hotel side, your pricing has remained somewhat consistent, and you've also gotten rid of a lot of the tail risk. And so hotels become, again, on that relative basis, a little bit more interesting than they were last year. And I think that kind of creates a good opportunity this year. But I don't know, Amin, how much you guys think about a certain part of the fund being hospitality or looking across various asset classes?
I think we look at it very, very similarly to the way you do, which is, our job is to provide the best risk reward in real estate, and sometimes that means it's hospitality. And we've had funds where hospitality is 35-40% of the fund, and we've had funds where it's 10 to 15%. So we're really, really opportunistic in that way. Can be flexible.
And you reference the CMBS market opening up, and in general, it feels like the financing markets are opening back up. Just to give context, Jatin, maybe you can start. Where do you think financing costs and leverage levels were, say, summer of last year, to where are they now? And would love your perspective, especially on the CMBS side, what similar things are playing out.
Yeah, so on the regional local side, I think a lot of our buyers are looking at SBA debt, right? And so that's floating. I know that there's a fixed option to that as well, but typically what they take out is floating debt that's based on prime, essentially. And so, that's floating. And so about a year ago, I would say that we were, roughly in that 8%-ish range, 7-8%. Now it's roughly around the same, if not a little bit higher. And the great thing about SBA debt is that you can go higher leverage, and I think that attracts a lot of regional buyers. The first-time hotel owners at times, they're trying to scramble to get the cash capital to buy an asset, and that's why the deal size comes in. So under $10 million, if you're able to take out an SBA debt, it's 20%, so it's $2 million and below $2 million. And a lot of times in these local regional markets, you have a strong player, a veteran player in those markets that have been there for 30, 40 years, have a portfolio of assets, and may have a family member or a friend that wants to get into the industry. And so they come together and join and kind of buy that kind of corner of the market. And that's why we're seeing continued success in that space. But interest rates are tough. We're hoping for rates to drop here soon. I think there was a lot more optimism over the past 90 to 120 days, and hopefully that comes to fruition here soon.
And I would say, like, on the larger loan side, I'm certainly not a debt expert or CMBS expert, but I think something that we've seen that has been encouraging this year is less on the all-in rate side, because obviously, your base rate remains high, and so even if spreads come in a little bit, like, it's marginally helpful, but it's not going to move the needle on the deal. But what we've seen is, like, real certainty of execution and banks willing to take commitment, or willing to offer commitments, take risk, and just be much more aggressive in that offering. And I think, as you look at larger transactions, what that does is it just gives you confidence in your ability to execute, ability to price that, and not, assume that your debt's going to blow out by 50, 75 bips between signing and closing a deal.
Great. And Katie, you both have fairly sizable portfolios. Fundamentals has been a big question that has been on people's minds for several years now, whether it's return to office, drive to leisure. Feels like 2023 was a more kind of new normal. How are you seeing fundamentals play out right now, and what is something that you're, like, excited about on the demand side, and what is something that you view as sort of like the high risk as you're looking at your portfolio right now?
Good question. I mean, I think 23 wasn't, it was better than 22, but it wasn't as strong as we were hoping. But I think there are a couple things that we're very excited about at Noble. So I think just kind of from a macro perspective, muted supply coming into the industry over the next, call it 5 years, makes us feel good about it. From a demand perspective, the hybrid work, while it does kind of impact some of the corporate travel, right? I think having the flexibility of Monday out of office, Friday out of office is generating tangible demand and incremental room nights into the market that we haven't seen before, which is real, and it's very tangible. But I also think, as you look at just general demographics of the population, over the next 5 years, there will be 40 million more people in the 25 to 39 and 55 to 79 demographic, which is the largest traveling demographic in the US. And so that allows, the increased demand allows for increased pricing power against the muted supply backdrop. Just gives us a lot of, optimism and confidence in the hotel sector moving forward.
I think by far the thing we're most excited about is Taylor Swift. She, on nights that she has concerts, I think occupancy is 11% higher, and ADR is $50 higher, plus the tie-in with the NFL. I mean, this is just going to be great for the U.S. economy going forward. So we're super excited about that. But in all seriousness, I think there are a few things on the demand side that could work out positively. If you look at group travel, it's now 1% below 2019 levels. At ADR, that's 10% higher. We don't think group travel is structurally impaired. In fact, we think with increased work from home, group travel becomes all the more necessary to build culture across organizations. If you look at corporate travel, it's still oscillating between 70 to 80% of pre-COVID levels. We could still have recovery in that segment. Domestic leisure has obviously been quite weak this year. But the consumer is still strong. Their net worth to disposable income ratio is 700%, which is pretty high compared to historical levels. And there's been a lot of conversations about credit card delinquencies, but if you look at the different vintages, most of it is because of 2020 and looser lending standards. It's generally at like 50 bips above historical average, so it's not really a major concern. So there are a few things that could break the right way, but fundamentals are getting weaker. They've been getting weaker over the last few months, and it's something we're definitely closely tracking.
And Amin and Katie, is there a certain area of your portfolio where you're seeing more strength, be it the extended stay or select service versus an area that you're seeing more weakness?
The area where we're seeing the most strength is actually our urban portfolio, because that's and it's off a lower base. So if you compare it to 2019, we're still doing a lot of comparisons to 2019 because it's really like the last stabilized, quote unquote, stabilized year. And I think that strength in urban will continue. We're continuing to see that. We're seeing a lot of strength in New York City. As you guys know, over the last cycle, New York City had multiple years of 5% plus supply shocks. So if you look at RevPAR in 2015 versus 2019, it was actually down. But if you include resort fees, it's flat. But going for the growth in New York City over the last few months has been incredible. We think going forward, the supply-demand setup is really positive. And this is also without international travel. International travel is still 80% of pre-COVID levels, mostly because of weak demand from Asian countries, which will be particularly helpful for our coastal cities like New York City.
Just by nature of select serve and extended stay, I think we've seen broadly across our portfolio that it's performing in excess of 19. But that's, we don't have as much urban exposure, so a lot of the markets that we've invested in are really kind of back in excess of 19. I think some of the bigger group convention markets still have a little bit of room to go. But generally speaking, we've been pretty pleased with how the portfolio has been recovering.
Jatin, what is the most common concern that you're hearing from owners, whether it's on the expense side, CapEx?
I think it's all the above, honestly. It's a very tough industry. Expenses are tough. Fixed costs are tough. Labor's tough. I know we always talk about property taxes increasing, but now we're seeing increases in utilities as well in certain cities and jurisdictions. And, I hear stories all the time from friends and family who are physically operating these hotels and doing shift and making rooms, and it's very tough. It's very tough to find really good labor. I think last year there was an example of, you put out an application, you get 50 people to reply to an application, maybe 5 people say they'll interview, and nobody even shows up. And I think that's really tough.
Katie, anything on the expense side that you guys are really worried about?
I mean, I think it's very similar. I think from a recruiting perspective and labor perspective, it is still challenging. We're getting creative with how we do try to source some of that talent for our vacant positions. We've been finding actually that people are more responsive to a text message than any sort of email or things like that. So we've had some traction there, but it is challenging. And hospitality is one of the real estate classes where there is such a dependence on labor relative to some of the other real estate verticals. And so it's something that we continue to try to think about creatively, find solutions to. Leveraging technology in any way that we can to really make our hotels more efficient from a staffing perspective. But labor is definitely something that we're keeping an eye on.
Great. As you think about the next phase of growth for each of you in your careers, when you look at the leaders in your organization, what do you think is going to help you reach that next level as you think about reaching the C-suite?
This might be a little bit of a cop-out answer, but I think, some of it is obviously developing and continuing to grow, and some of it's being in the right place at the right time. And I think I've been fortunate to, join a firm that was $130 billion of AUM when I accepted the offer, and had a very small real estate group, and today is $550 billion and has a $70 billion AUM under real estate, and we're not shy about saying that there's a lot of additional growth beyond that. And so I think, some of it's, obviously continuing to grow, continue to develop, and continuing to, follow in the steps of those ahead of me, and some of it's being, somewhere where there is a lot of growth opportunities, and that's.
Yeah, very similar answer with assisting with growth. Hunter's gone through pretty significant growth over the last 12 to 24 months. We've added an office in New York. We've added an office in Austin. We've added resources in Miami. We just hired 2 individuals in the capital markets division in Los Angeles and Illinois. And so it's just continued to grow and expanding on our advisory services and training the next generation, allowing them to grow can only help us kind of take that next step.
Totally agree on training the next generation. I think mentorship and management is going to be a core focus. Still a long way to the C-suite, but the next couple of steps to that really, which really gives you leverage and the ability to scale your business. I think another key component of this is spending a lot more time with our clients, our limited partners, understanding their needs better, exploring new products that we could offer them. I mean, we launched our non-traded REIT, which was targeted at retail investors, which has been a major growth engine for the firm. So continuing to think about ways that we can be creative about growing AUM and getting more involved in that side of the business beyond the acquisition side.
I think I agree with everything that's been said, but I think it's a couple things. I think it's, having continued self-awareness on, the certain elements that you're still missing in terms of when you do look at the C-suite, what are the qualities that that individual has and what are you missing relative to that individual, I think is one piece. But I think, the second piece, to Amin's point, is really understanding the broader lens of the business. I think CEOs have to be highly strategic in how they're thinking and, having a really comprehensive understanding of lender relationships, development from our perspective. So outside of acquisitions from what I do at Noble, it really does kind of give you the skill set to eventually think more strategically and get to that C-suite position.
Great.
Katie, what do you think MIT has that you don't?
All right.
No comment.
Before we wrap this up and open it up for a couple of questions, a couple of fun questions from my side. What's your favorite book to gift?
I don't practice it enough, but Essentialism.
The Alchemist.
You're Not Listening by Kate Murphy.
I like gifting books because it's a gift, but it's also a bit of homework that you're giving your friends. I've really enjoyed gifting Green Lights by Matthew McConaughey recently.
Awesome. And if you were not doing your job, your current role, what would you be doing? What would be an alternative career?
2 answers to that. In like a real career, I would probably be doing something political and less, more of a fun career. I would probably be a ski coach.
I was gonna say a ski racer, maybe.
I'm not good enough for that. So.
I think I would be doing something in production. I think it would be in film or music or something along the lines of that.
You're in the perfect city.
Layers and creating. Yeah, exactly. Right. So yeah, probably that. Yeah, exactly.
Probably a pretty boring answer, but I'd probably be a doctor. But if I could do whatever I wanted, I'd probably be a surf instructor in Bali or something exciting.
That sounds idealistic.
I think dog walker or dog trainer, something with animals.
But very picky on the dogs.
Oh, they got to be so cute. Only cute dogs.
Well, thank you guys. Really appreciate it. Thank you for everything. Any questions before we let them go? Nope. All right. Thank you.